And you're just in time for your weekly, most comprehensive look at the world of business, finance, and economics. Tonight, we are hosting the Managing Director and General Manager for BAT East Africa, that is Crispin Achola. Welcome on set.
Thank you very much, Julian. It's a pleasure to be here today.
Karibu sana. Over the last 18 months or so, we've had significant transition at BAT Kenya. New CEO, new CFO, new company secretary, new chairperson of the board. How has it been, especially coming in within the context of COVID-19?
I think that's a very interesting observation, Julian, and you are correct in those observations. I think for me, coming in as the number one of the business here with that change around me has been quite instrumental in the success we're seeing in the business since the year started. And the reason for that is that beyond the change in the team, there was also a significant change in the operating environment triggered by COVID. So I have just felt that with a new team in place, without anchorage into the previous pre-COVID practices, it's been easier to navigate and pivot and drive change through the organization as a result of having a fresh pair of eyes working around me. So I think it's been more beneficial and then perhaps disruptive in terms of driving the business forward. Looking at
the half-year numbers you put out as BAT, very strong top line, but the bottom line was up 0.7% compared to double digits on the top line. And the question here is, are you saddled with such heavy fixed costs that you are not as nimble on the cost side, especially within the context of the COVID pandemic?
So I think, Julian's, we need to unpackage why that is the shape of our results. I think the first one is you'll recall that last year, the government, as part of the COVID support, reduced VAT from 16 to 14%. Corporate tax was also reduced from 30 to 25%. And all that was reversed at the beginning of this year, and that's reflected in our results. So there's higher taxation in comparison to the first half of this year vis-a-vis the first half of last year. The second thing is that the first half of last year was the biggest impact on COVID in our operating environment, and as a result of not knowing the outlook of the operating environment, we took very significant cost-cutting measures, more in the second quarter of last year, and you would then have seen that there was significantly reduced cost that we flowed through in the first half of last year. This year, we have returned to a degree of normalcy in terms of running the business, and the cost of that normalcy has crept back into our results. I think the third thing is that in the first half of this year, we've made quite significant investments in our portfolio transformation, and a lot of the costs associated with that transformation sat in the first half of this year that will not be replicated in the second half.
Okay. I'll be coming back to the portfolio transformation a little later, but still on your results, a number of manufacturers, because of their nature of their heavy imports coming in, one of the issues they had to deal with last year was the shilling getting roiled in Q3, Q4. How much of a headache was this for you?
Yeah. So at BAT here, we're unique because whenever the Forex, for example, devalues, as much as it does hit our cost of goods, because we depend quite a bit on imported raw materials, surprisingly, which a lot of people don't know, is it also benefits us because from an operation perspective, we export about 65% of all the product we make in our Likoni Road factory here.
So they become cheaper?
So they become cheaper. So when you look at the increased costs of imports on materials vis-a-vis the benefit we see on exporting finished goods, we actually end up with a net benefit as a result of currency devaluation.
That's quite a sweet spot to be at.
It is, but I think, we just also have to make sure that we're competitive in terms of our local conversion costs to make sure that we can continue to maintain and attract more on that export business. But export is a very big part of our business reliability and continuity here at BAT.
A number of manufacturers of the scale that BAT is have cited one challenge with me, that COVID precipitated a big knock-on on their retail partners. So they run into cash flow and liquidity problems. You have to step in with intervention measures with some partners, but then that means you're onboarding their credit risk onto yourself. How is BAT managing this?
Yeah, so, it's quite unique for us because even prior to COVID, we had actually seen a situation where retail liquidity or trade liquidity was already becoming a concern. And what COVID did is COVID just exacerbated a trend we had already seen. So when we saw this as an emerging trend, we actually partnered with banks and financial institutions to start funding some working capital components for the trade. So for us, when COVID hit, it was about acceleration of a program that we're already running rather than having to start from scratch. And as it sits here today, just between our wholesalers and our retailers, we have quite a substantial element of funding that we have been able to partner with banks, specifically Equity Bank, to get funding.
Okay. Going back to the capital markets, BAT is one of the companies in this country which I must observe has a very generous dividend policy. And whereas your shareholders might be happy, the question which emerges is it really prudent in an environment like COVID-19 where many companies are getting aggressive on a capital preservation standpoint? Do you see yourselves able to maintain the 80s payout in the medium to long term?
I think it's a good observation there, Julian. Yeah, I can see definitely you read our annual report. But our dividend policy has been to pay at least a minimum of 80% of our profit to our shareholders. And this has been something that we have done for an extended period of time. Yeah. When we look at the profile of our investors, who tend to be long-term institutional investors forming the bulk of those who hold our shares, we believe that beyond the capital gains that is made on the appreciation of the share, part of the reason they make the investment in the share is because of the strong dividend policy we have. So as an organization, we have made the decision that in terms of looking for capital to drive future expansion of the business, we have competitive opportunities to do it either from borrowing from internal sources or borrowing from external financial institutions. And it's on the basis of the ability to access capital competitively that we have opted to adopt a fairly aggressive dividend policy.
And still on the capital markets, I look at the BAT share and sometimes I get the sense that were it more liquid in the market, maybe would have had a great opportunity to unlock the value of this counter because the demand you can see is there, but the liquidity is quite constrained. And those who are holding it, hold it for the long term. Is something like a share split ever on the option on the table for you?
Yeah. So Julian, you're right. The liquidity of the share is relatively low. And it goes back again to the profile of those who hold the shares that tend to be either pension schemes, or large institutional shareholders who are happy with the performance of the share, so they're not trading in it. Yeah. So when we have looked at the performance of the share, coupled with our aggressive dividend policy, we believe that and the fact that it's very low liquidity in terms of its trading. This for us is a testimony that our shareholders are happy and we don't see the benefit that would accrue with something like a share split or further dilution of BAT selling more shares in the marketplace. Currently, 40% of BAT sits on the Nairobi Stock Exchange, which means parent company holds 60%. And at 40%, we believe that we're playing a good role of allowing local and international players on the Nairobi Securities Exchange to partake in the value we're creating here locally.
Chris, a number of manufacturers, I should say many of them, are grappling with the issue of illicit products in this market. And I have two questions here. One is that how much is a headache for that? Is that a headache for you as BAT? And second, to what extent do you think the taxation regime then catalyzes the proliferation of these illicit products? Because granted, we always see your products being targeted in this sin tax every other financial year.
Yeah, so illicit trade is actually one of the things that keeps me awake at night. And the reason for that is we have independent research that we run using an independent third party. And the latest read we got was that 1 out of 4 cigarettes sold here domestically in the market is illicit, which means illicit trade is at least 25% of the category. I mean, this is a massive leakage for us from a profitability perspective, but it also has a knock-on impact on government revenue because that 25% illicit trade incidence is almost 4 billion shillings worth of excise revenue for government. The key driver really has been, I think, two drivers. I think the first one is that our cigarette prices here in Kenya are relatively high in comparison to neighboring countries. And the reason for this is that the tax, excise tax charged on cigarettes in Kenya is almost double that charged in Uganda and Tanzania, which has a knock-on impact on higher consumer prices. So as a result of these high prices, we've kind of seen a vacuum being created at the bottom and that illicit trade is filling as we've been forced to price further up our portfolio as a result of excise. I mean, just to give you some numbers, between July 2019 and October 2020, the cumulative increase on excise and taxes on cigarettes was 25%, during which inflation was probably even less than half of that. So we've had to price significantly higher than even inflation because of the excise that we've had to pass on to consumers. For me, the real worry, I'll be honest with you, Julians, is not the fact that it's moved from 0 to 25, but the concern that it can move from 25 to 50 overnight. It's difficult to get to your first 25, but it becomes exponentially easier to grow at an exponential rate when you have reached a number like 25. Having said that, I have to give my accolades to the Kenya Revenue Authority because, in our discussions with the Kenya Revenue Authority, it's very clear that they understand this menace and the revenue loss associated with it. And we are quite pleased that it's getting a level of attention that is commensurate to the nature of the problem. So, to the Kenya Revenue Authority, the effort is there. We just need to see bigger results coming through.
Still on the issue of excise and inflation, every year now we have the inflation adjustment of excise duty. To what extent does this reflect on the price sensitivity side, on the consumption of your products, especially when we have an environment like the COVID one, where, to be honest, I mean, incomes are significantly subdued?
So, whenever we have to increase our prices, we notice a contraction in the market. And this is really driven by the fact that consumers are really pressed. During the COVID period, consumer disposable income took a big knock. Yeah, and in our discussions with government, we requested that that they rethink taxing the category during this period just to allow for the recovery. Because, just to give you some numbers, last year, on the back of COVID disruptions, our business shrank by about 24%. Okay, and if that was, to be further compounded with taxes coming through this year, that probably would have resulted in further shrinkage. Yeah, I think the fortunate thing is the government understood the state of the economy. They made a decision not to increase taxes on our category in the Finance Act of this year. And on the back of that, we are seeing growth in the high teens as a result of that. And this year, as a result of the growth that we're seeing on our volumes, we'll probably be paying close to, in our half-year results, we actually paid about 26% more on taxes in the first year to government in comparison to the first half of 2020. So the recovery is coming through. We are seeing it in our volumes. We're seeing it in our profitability. And more importantly, the government is also seeing the benefits.
The company has been on a journey of portfolio transformation. And the first thing here is that the nicotine pouches, the taxation of it has been a subject of conversation. There was the view that perhaps what was proposed and later passed in the Finance Act was not reflective of the lower risk profile that they offer the market. What's your stand as things are right now?
Yeah. So just to explain the concept of the nicotine pouches, what we are seeing emerging in our category is that consumers are looking for safer ways to obtain nicotine, because that's what they're looking for in our product. And cigarettes traditionally has been the most risky way of obtaining nicotine. because of the combustion associated. And that's where the problem comes from in terms of all the burning that occurs in the attempt to get the nicotine out of the product. So nicotine pouches delivers nicotine without combustion and the toxicants associated with combustion, and it represents a less risky way of obtaining nicotine. So in our discussions with the regulators, we've tried to always say that the tax that is imposed on our new categories like nicotine pouches needs to reflect the lower reduced risk in comparison to cigarettes. And I'm actually quite happy to report that the tax for nicotine pouches that was gazetted in the finance bill in July actually does reflect the lower risk nature of the product. So we're happy with the outcome, that the science supports the fiscal policy that has been implemented. Yeah.
Walk us through your value chain, and why I ask this question is because a lot of the manufacturers you talk to will tell you that main challenges is that one, the value chains are very fragmented, and therefore standardization becomes a bit of a problem. How is it in the BAT experience?
In BAT, we actually have a relatively complex supply chain if you compare us to other manufacturers in the country. And I'll just point out a few areas where we are significantly different. I think the first one starts with the fact that we are basically a seed to smoke business, which means that we contract farmers and we have heavy oversight and involvement in tobacco growing. Currently, we grow in South Nyanza and parts of Eastern province, yeah, and we have about 5,000 contracted farmers growing leaf under contract, directly supplied to us. Yeah, so there's a lot of issues just in agriculture in this country, whether it's weather, quality, disease, and that causes a lot of pain, obviously, in managing that part of the value chain. The second element of our value chain is that we have a factory right here on Likoni Road where you're interviewing me. And our factory here actually is more of an export factory than a domestic factory because 65% of whatever's produced in my factory actually ends up in export. So, just managing the regulations around exports, searching for new markets beyond fulfilling domestic markets is quite a significant job. I think the third area in terms of our value chain has to do with the distribution of our cigarettes. We rely on 7 exclusive distributors to distribute our cigarettes right across Kenya. And we are seeing increasing challenges in our distribution setup, really driven by things like the trade capital we spoke about. Yeah, but we also do see challenges in things of like regulations around what we can do to generate consumer demand for our products, just given the fact that we are under a Tobacco Control Act in terms of what we can and cannot do to generate demand for our products. So it's challenging, but I think there's a lot of talent and experience within the organization that consistently allows us to overcome these challenges and deliver strong profits on a year-on-year basis to our shareholders.
The 65% of your output, which is destined for the export market, how diversified is that export market, and why that's important is because one, COVID brought us to the reality that supply chains can be disrupted, and you need to have a very solid domestic base, much as you countervail with a very strong export base. And how does it look like? Yeah.
So in terms of our export markets, we're exporting to the wider East African community. So whether that be Rwanda, Uganda, or Tanzania. But we also go beyond East Africa, and we're exporting to the Horn of Africa. In fact, Somalia and Somaliland combined is our second biggest market after Kenya in this patch. And we also do export into the Indian Ocean islands. So places like Mauritius actually get supplied most of their product out of here. I think, our domestic market still does represent the bulk of our business. It's as a single entity. So Kenya as a single entity is about 40% of our volume base. But I think, the beauty for me in terms of, running a significant export business is it takes geographical risk into managing my business. So it's always going to be a situation of some markets are doing well while others are struggling, and it changes year on year. But just having that spread of geographies to play around does help bolster and reinforce our ability to deliver strong results year on year.
Chris, looking into 2022, a lot of the CEOs, CFOs I'm talking to raise the fact that, one, we are not very sure where we are going with COVID. Right now, the positivity rate looks encouraging, but who knows about a fifth wave? Then we will find ourselves neck deep into an electoral cycle, and they're looking at a twin risk here. When you look ahead, how do you paint this landscape?
So I think, every election year in Kenya, from a business perspective, brings a bit of anxiety because we do tend often to see, but not always, things like challenges of access to market. Yeah. And I think beyond that, this year, as you say, we don't know what shape COVID would take. And in the event that it takes a downturn in terms of positivity rates and its impact on the economy, that would be a double whammy in terms of volatility out of COVID and unpredictability coming out of the election cycle. But, I think as a business, what we have done is we have taken a step back and kind of drawn out scenarios of what do we think could play out. And out of these scenarios, we have developed what we call business continuity plans. So I think, from an organizational perspective here at BAT, we're anticipating what could be, and we're making sure we have plans in place in the event that some of those adverse elements come to fruition. So I feel quite comfortable that should we see this volatility in the operating environment, we have action plans and contingencies in place that should either help us weather through without impact, or where there's an impact, that this impact is minimized.
Allow me to go back as we wind up to the issue of portfolio transformation, sportsman to Rothman. I don't think there's any transformation which has intrigued investors more than that one. What's the logic behind it? Where are they going with this? How is it faring on as far as the migration is concerned? Give us more detail on this.
So I'll take a step back and just kind of say, why are we migrating our brands? And, here at BAT, what we have observed is that our brands tend to fall into two categories. The two categories would be what we call local heroes, which are brands that have very strong national heritage and history. And our second category would be what we call international brands. What we have noticed is that in the long run, our anticipation is that consumer preference will shift out of national brands into international brands, just because of the equity that those international brands hold. It's not that our local brands do not hold any equity, no. But far from that, it's just that proportionally, in terms of proportion, we believe that our international brands in the long term will have bigger appeal to our consumers. So this is part of being consumer fit for our portfolio. I think the second element is that when we sell international brands in a market like Kenya, it opens us up into a global innovation pipeline.
Chris, I must tell you that the skeptics of what you've just said, the argument is that BAT is becoming extremely global market-centric, and especially in a domestic market which is extremely price-sensitive around taxation, inflation. Where does it leave you as far as your local footprint is concerned? Does that bother you?
No, I don't think it bothers me because as much as we're moving, let's say, into a more international business, in our offerings, I think the business is actually being managed more and more by locals. Yeah, so I think that's a perfect fit where you have international brands being brought into the market with a very strong Kenyan talent in this organization. Deploying that, because then you get the best of both worlds, where we tap into the international knowledge and offers, but we have Kenyans who here make sure it's relevant. I think for the community. So if I look at, for example, my leadership team, the team that reports directly into me, literally 85% of that team is local Kenyans. So I think that's quite important in making sure that I have people who can take international offers, look at them through local eyes, and make sure they're deployed or relevant to our local consumers here. Yeah.
Right at that point, by Chris takes us to the close of our conversation on Business Redefined, where we have been unpacking BAT East Africa, looking at the numbers for the half year as well as the portfolio transformation and a few other issues around the regulatory environment. As always, we shall continue to shed light on these issues for the interest of the public. Stay tuned.